So we've established that our goal is to buy and hold stocks. But what are stocks in the first place? Stocks are essentially small pieces of a company. Say you start a company called ABCD. You own the entire company right now. One problem you might face is that you want to make your company bigger, but you don't have enough money to buy machines and hire more people to expand your business. So what do? Well, you talk to your friend Adam, who's a bit rich. You say, hey, I will give you 10% of my company, meaning that if you sell your portion of the company eventually, you will get 10% of however much my company is worth. But in exchange for that 10%, I want $10. If you're saying $10 is worth 10% of the company, then $100 is equal to 100% of your company. That is your company's market capitalization, also known as market cap. So if you cut your company into 10 pieces or 10 stocks, or some people like to call it shares, you're essentially giving one stock or one share of your company to Adam. If you cut your company into 100 pieces, which is 100 stocks, you're essentially giving 10 stocks to Adam, because that's 10% of 100. We can go even smaller. You can divide your company into 10,000 pieces. So if your company's market cap, which is how much your company is worth, is $100, $100 divided by 10,000 is 1 cent. Each stock or share of your company is worth 1 cent. You give Adam 1,000 stocks, which is 10%, but he's still only going to pay $10. You still hold the rest of the shares. Let's stick with the storyline that he has 10 shares worth $1 each. So right now, I've talked about a few things. Market cap, which is how much the company's worth in total, and what a stock or share is. A stock is essentially a piece of a company. Big companies like Apple have a market cap in the trillions of dollars, meaning that each stock is a very, very, very tiny piece of the company that you as an investor can buy. One of the reasons companies sell stocks or issue shares is to raise money for their company. But why would someone exchange their money for a stock? Well, if we go back to our company ABCD, our friend Adam hopes that we're going to make good use of that $10 he's giving us for 10% of the company. Now let's say as owners of ABCD, we decide to invest in machinery and more employees. We invest in AI as well. Now we're producing more goods, serving more people, and it really seems like our company is going to keep on getting better. When other friends start to hear about this, they're like, hey, can we also invest in your company? You're like, nah, I want to hold on to my shares because I believe my company will keep growing and I want to make more money in the long run. So your friends are like, oh man, that sucks. But then they decide, wait a second, let me ask Adam if I can buy his stocks from him. There are no rules saying that Adam cannot sell his stock to someone else. So Adam's like, actually, I'm going to sell some of my stocks. I'm going to sell 5 of the 10 stocks that I own. 5 stocks are currently being exchanged. So that is considered volume. If you see that a stock for a company has 50 million as volume, that means 50 million stocks for that company are being exchanged, or also known as traded, in that day. Volume is the number of stocks for a company being exchanged in a given trading day. So going back to our example, let's say that more than 5 people want to buy Adam's stock, and some people even want to buy more than one stock. So it's like a competition now. So Adam decides that he's going to hold an auction. The highest bidder will get Adam's stock. So highest bidder means whoever is going to pay the highest price for that stock will get it. This concept of an auction and bidding is actually what happens in the stock market. The stock market is like a big live auction. It's a platform for exchanging stocks. Sellers, people who are looking to sell stocks like Adam, are listing, or in other words, putting up their stock to sell on the stock market. Buyers are bidding, being like, oh, I'll pay $1, I'll pay $2 for the stocks that are listed on the market. Obviously, this all happens super duper fast, but in simple terms, that's how the stock market works. The highest bidder for the stock gets to buy the stock. Let's say in our example, Lucy is the highest bidder, and she tells Adam that she'll pay $3 for each of his 5 stocks. For Adam, the $1 he initially paid for each of those 5 stocks turned into $3. It tripled in price. On those 5 stocks specifically, he went from $5 to $15. He made a $10 profit. Let's pause right here to break some misconceptions people have with the stock market. First, you only lose or make money in the stock market once you sell a stock. Adam made $10 on the 5 stocks he sold, but on the stocks that he did not sell, he did not make or lose money. If you buy and are holding a stock, you don't make or lose money. You only make or lose money when you sell a stock. I also want to mention that when Lucy says she's going to pay $3 for each stock, it is implied that people think one stock, or like 1% of ABCD company, is worth $3. Remember, we split ABCD into 100 stocks, so each stock is 1%. If 1% is worth $3, then 100% will be worth $300. So our market cap for ABCD, how much the company is valued at, is now $300. ABCD went from a $100 market cap to a $300 market cap just like that. Let's think about an alternate scenario. As the owner of ABCD, you decide that instead of investing that $10 you got from Adam, you're going to gamble it and you end up losing that money. So now you can't expand your company, you can't hire more people, and news reporters and other people catch on to this. They see that ABCD is not expanding and they start making news articles saying that the owner of ABCD is not investing in their own company. Is ABCD struggling? Will ABCD go bankrupt? All of a sudden, everyone's super scared. Adam's like, oh no, I'm gonna lose all my money. He's like, let me sell my stocks as soon as I can. He lists all 10 of his stocks on the stock market. But there aren't many people looking to buy ABCD stock because of all the bad news articles that are coming out. Only one person, Jacob, wants to buy, but since he has no competition, he decided to purchase the stock for 50 cents each, and Adam agrees to sell it at that price. Each of Adam's stocks went from $1 to 50 cents. Since Adam made a reactionary decision to sell his stock based on news and what people think, he ended up losing money. His $10 investment went to $5. He lost 50% of investment. To come back to the point I mentioned before, Adam only lost money in this situation because he decided not to hold and sell. If Adam held on to his stock, there is a chance that the stock eventually goes up and he ends up making money in the long term. Like he initially paid $1 for each stock. After the bad news, it went down to 50 cents. But then, maybe that was fake news. Maybe ABCD was just having some struggles, but they came over it. The stock price could rise back to $1 or even go more than that, like $2. If Adam didn't sell and waited till it goes back up, he wouldn't have lost any money. But Adam made the mistake of selling, and this is how he lost money in the stock market. This is exactly the mistake many people make, and they'll be like, oh, I lost some money in the stock market. The stock market's a scam. Nope. Adam just made a mistake. Investing is not emotional or reactive. We always buy and hold. The stock market is all about buying and selling stocks. If there's a good narrative, a good feeling around the stock, there's going to be more people holding onto that stock, and there won't be many sellers, so there's low supply. But a lot of people want to invest in the stock because they think it's going to be a great company, so there's going to be a lot of buyers, thus demand. Demand is high, supply is low, the price of the stock goes up. An example of this is Meta announcing that they're going to invest into AI, and everyone thinks Meta is so amazing, so the demand is high, not many people want to sell, supply is low, so Meta stock price goes up. If there's bad news around a company, like, oh, Tesla sales are down in 2025, then people are like, I don't want to hold on to my Tesla stock anymore. There's going to be a lot of people looking to sell, high supply, but not many people looking to buy Tesla stock, so low demand. High supply, low demand means that the stock price will go down. A stock's price going up and down is based on how many buyers and sellers are currently in the stock market for that specific stock. The number of buyers and sellers is dependent on how people feel about that stock or the stock market in general at that moment in time. It's based on people's opinions. But opinions and market sentiment, which is how people feel about the market as a whole, can change over time. Based on what I see on the news, Tesla is one of those stocks where it's like 1 month, everyone's saying Tesla's so amazing, it's going to produce revolutionary self-driving cars, and the next month, everyone's saying Elon Musk sucks. With all that being said, how in the world are you or other people supposed to figure out if a company is good or a bad investment? One thing that many people do is analyze the company or the stock. They do fundamental analysis to analyze the fundamentals like the number of sales, balance sheets, revenue of a company to see whether it's a good or bad company. Other people may do technical analysis, meaning they look at how the stock price has moved recently. They look at patterns to predict if the stock price will go up or down. If we pick the wrong stock and the stock decreases a lot in value and never goes back up, we can end up losing all our money. So how do you make sure we only pick good companies? This is pretty hard in my personal opinion. And the good thing is that we don't have to worry about that at all because we're going to invest in index funds.